Section 6, subsection 1 of the Nigerian Tax Act, which says that the profits of a Nigerian company are deemed to accrue in Nigeria, whether the profits arise and whether or not such profits have been received in Nigeria.
Hello everyone, welcome back again to Excel with Google. In one of my earlier videos, specifically this one, where I talked about the introduction to the new Nigerian tax law, I promised to do a series of videos on individual topics of the new Nigerian tax law. In this video, I'll be focusing on the company income tax. Here I'll be sharing an edited session of a professional webinar where myself and a colleague was invited to speak on this exact topic. This recording has been edited to clearly highlight the key changes and updates of the company income tax under the new Nigerian tax law. Please sit back and listen.
Speaking now on company income tax. So basically, what is company income tax? This is the tax that is usually charged on profits of companies registered in Nigeria or foreign companies that earn income in Nigeria. So as long as you are a registered company in Nigeria doing business in Nigeria, your profits are subject to company income tax.
And even if your company is not registered or does not reside in Nigeria, as long as you carry any form of business activity that earns you income from Nigeria,
you would also be paying company income tax. And when we talk about the profits, you need to understand that I'm talking about profit and not your turnover. Profit has to do with the gross income that you must have generated from that business. And gross income, which includes turnover plus other income, whether operational or non-operational income. The total income, deducting every other allowable expenses, that is what becomes your profit that will be charged to company income tax. And just so you know, allowable expenses has to do with your operational expenses. That's the expenses you incur in running the business. You can also get some reliefs and allowances like the capital allowances, especially for qualifying assets. And that can also help reduce your accessible profit at the end of the day. So it is that profit you get after these eligible and allowable deductions that becomes charged with based on the company income tax rate.
there's a distinction between small and large companies.
But based on these new tax laws, the threshold has been changed. For small companies, it has been expanded.
Small companies are now regarded as companies with a total turnover of 100 million naira and below, and total fixed assets of 250 million naira and below.
So these two conditions must be met. What if you have a turnover of
100 million naira and above?
Even though your fixed asset is lower than 250 million naira, you are not a small company. For you to be regarded as a small company in Nigeria, to enjoy company income tax exemption, you must have both your gross turnover
to be below 100 million naira
and your fixed assets should also be below 250 million naira. Moving on, the new tax act also introduced what is called controlled foreign company rules. Basically, this is a rule that tries to stop companies from using foreign subsidiaries outside of Nigeria to avoid paying taxes in Nigeria. So most companies, especially Nigerian companies that controls usually more than 50% of a foreign subsidiary that pays little tax abroad, what they do is they try to hide in such countries because their tax rates are low and would want to refuse sending back their share of profits here to Nigerian company, which would normally be subject to company income tax. But now what the rule is saying is that so long as you are a Nigerian parent company that has a control that controls a foreign subsidiary abroad, even though your profits that you have earned abroad is not sent back, even though you do not share send it back in form of as a form of profit here in Nigeria, so long as you have declared that you have earned that profit, that profit will be subject
to company income tax, which is in line with Section 6, subsection 1 of the Nigerian Tax Act, which says that the profits of a Nigerian company are deemed to accrue in Nigeria, whether the profits arise and whether or not such profits have been received in Nigeria.
the idea about this is to prevent companies from shifting their profits abroad. This is trying to bring every company into the tax net and to ensure that there is fairness, especially when it has to do with large companies. There is also a new introduction of the new tax act as it has to do with companies, and this is called the minimum effective tax, aka top-up tax. So what does this mean actually? So for companies, especially Nigerian companies who are members of a multinational groups with aggregate group turnover of 750 million euros and above, or if you are not a member of a multinational company, but you are a Nigerian company, a big company that has 50 billion naira turnover and above, you are subject to what is called the minimum effective tax. So let us look at it individually. You are a company who is a member of a multinational group. No matter where your company or your business is operating outside of Nigeria, you must pay at least the minimum tax rate of 15%. So if for any reason your what you are paying, your tax rate, your effective tax rate outside of Nigeria is not up to 15%, your Nigerian company here will pay what is called a top-up tax. So let's say, for example, your foreign profits, what you earned from your subsidiaries outside of Nigeria, is the effective tax rate is 5%. So Nigerian company here must pay the top-up tax of 10% to make sure that it is up to 15%. And this is also helping to prevent companies from shifting profits to where tax rates are very low, or to countries that have a lot of tax holidays. So how about if you're a Nigerian company that is not a member of a multinational group? You know, many times big companies try to have a smart way of reducing their effective tax rate because, yes, because they are large enough, they have the ability to enjoy some reliefs and allowances. So at the end of the day, they may be paying rates based on a rate that is lower than the regular 30% that should be charged on them. But what the new tax is saying is that if after you have enjoyed all your reliefs and allowances and your effective tax rate is below 15%, you must pay a top-up tax to ensure that it must be up to 15%. For example, if your company at the end of the day, after your tax rate, your effective tax rate comes up to say like 10%, there must be an additional top-up tax of 5% to ensure that it is 15%. And what this is trying to ensure is that it's trying to ensure fairness and ensure that profitable companies also contribute a minimum tax share to government. So what exactly is effective tax rate? How do we get or generate effective tax rate? Because this is not effective tax rate is basically different from the tax that is that's the applicable tax rate for companies. The actual statutory tax rate for large companies is 30%. But like I said before, companies due to allowances, due to some incentives, can have an effective tax rate below 30%. And how do you calculate your effective tax rate? It is basically your tax expense, which you must have at the end, after calculating based upon your accessible profit, what you have decided to be taxed to be paid to government. That is even after your current tax and your deferred tax adjustments that comes as a result of timing differences based on your capital allowance and depreciation. So that tax expense divided by your profits before tax is what you call the effective tax rate. And it is that effective tax rate that the government is saying must be at least up to 15%. So you cannot hide from it. Now let's move forward So we're also talking about how these new tax laws have tried to bring tax harmonization and also to reduce multiple taxation. So one of it is the from the introduction of development levy. So before now, we know that even after paying our company income tax, our profits are also subject to other form of taxes like the education tax, information technology levy, the National Agency for Science and Engineering Infrastructure levy, and the Police Trust Fund levy. So all of these are still paid by companies even after paying the company income tax. But with this new tax act, it is trying to harmonize all these additional levies into what we call the development levy. So for now, that development level is at 4% of their accessible profit. So after paying your company income tax, you now pay a single development levy of 4%, which also tries to reduce so many complexities with all these additional levies that used to be in place.
There you have it. I believe by now you already understand the key changes of the company income tax under the new Nigerian tax law. I would also be releasing more videos like this, so be on the lookout. If you haven't subscribed yet, kindly do so and hit the notification bell so you'll be notified anytime a video is uploaded. If you have any questions, please drop it in the comment section and I would be glad to answer all. Remember to subscribe, like and share this video. Thank you for watching and I'll see you in other videos. Bye for now.